Hello, everybody. Welcome. Thank you for attending this presentation. Go and let you know right up front, we're going to try to go through this as quickly as we can. We don't want to take up too much of your time. We appreciate you being here. So, lending club is what we're talking about. So, just to recap, to remind everybody what the lending club is, it's a peer-to-peer lending company headquartered in San Francisco, California. The company provides the world's largest peer-to-peer lending platform where borrowers can obtain unsecured personal loans for between $1,000 and 40,000, and investors, which is the focus of of the work we've done, uh, can search and browse the loan listings on the Lending Club website and select loans that they want to invest in based on the information supplied about the borrowers, the amount of loans, the loan grade, loan purpose, etc. Investors make money from the interest off those loans. The lending club itself, if you're curious, they make money both sides. They make money by charging the borrowers a fee and investors a fee. That's a fixed cost of doing business with them. And outside of the what we were looking at here, we were just evaluating the investment potential. And since you're able to look at the different components of the borrower, different data points, we actually use that to help identify different groups and populations to identify some interesting ways you could apply to this. The question was, should you invest? Should we, what our recommendation is, and a disclaimer is when it comes to investing, it's very difficult to make recommendations either way. All we can do is tell you what our results found and inform everybody to make the decisions that are best for them. I will point out, just for the sake of credibility for the lending club itself, they advertised 5 to 7% returns, and we were able to confirm that a lot of that a lot of our models did fall perfectly within that range. So I will go ahead and let's go and dig into it. So we evaluated investment potential um, across different loan clusters. We used a simulation and modeling approach that looked at interest rates, default risk, and loss severity. And as you see here, our specific methodology, we were able to cluster the loans into 5 groups that were based on the different attributes that you could search through as you identify loans to invest in. Uh, we took those and we ran simulations and calculated the return distributions from that. Used that to further inform the modeling, and then did optimization on the model using Sharp ratio, the return risk ratio, uh, to optimize our targets. So I will go ahead and jump right to the key findings for us. Um, and as you see, the risk versus return across categories should not surprise a lot of people. And just to explain the number at the end, we went ahead and with each of the 5 clusters, we simulated investing $2 million, and these would be the returns after a year averaged out for each of the clusters that we identified. Now, on the next slide, we'll give a little more detail on the clusters, some of the attributes of each cluster. As you see on the left of this, you see the number on the left there, the 1, 2, 3, 4, 5. That's the cluster number. And then you see the low risk has a lower yield. Obviously, most investments in high risk has a higher yield. Uh, you see, we were able to get consistently close to or over $300,000 returns, um, based on the risk profile, of course. Um, and to go ahead and show you guys kind of the clustering itself behind all this, as you see right here, um, cluster 5 is the low income, low usage borrowers. Obviously, when you have a high risk, high Sharp ratio, and a high return, you're going to see the standard deviation being a little bigger. That point that speaks directly to the volatility that you're going to see with that group. Conversely, if you look at cluster two, that's a nice, safe, um, low borrowers, low activity. Um, they're a safe bet. May not get a great return on that profile. Um, the best Sharp ratio of all, obviously, was the balanced borrowers, the ones that across that were in kind of the center of everything across the data points, the variables that we had looked at. Um, so yeah, good. If you're okay with risk, maybe go with number three. If you want a combination, maybe go with three, one, and two. You want to, I mean, I really don't see even though it's a 4.5 there for the balanced borrowers, the one over it is just 4.4, so not a big jump. So, wanted to close with Warren Buffett's um, quote here that risk comes from not knowing what you are doing. And I might rephrase that slightly. Not that I think I'm smarter than Warren Buffett, but just in context of what we've presented today, is that you can reduce your risk by knowing more about what you're doing. So, again, our recommendation is based on a model that the investment landscape offers varying risk return profiles because we can't really give a strict yes or no. It's up to each individual. This approach enables tailoring of investment strategies, though, based on individual risk appetite. Furthermore, I want to reiterate that this was data driven modeling and supports a more informed investment decision. And we encourage consideration of both the return and volatility when selecting a loan portfolio. And that's the basic skinny on this. Appreciate everybody's time. And if anybody has deeper questions, further questions, we would be more than happy to answer those. But that ends our presentation, and we'll now take questions.